Hello and welcome everyone. So today I'm going to cover SMT. This is something I get quite a few questions about. So I thought may as well just cover it in a nice, quick and easy module, and you shouldn't have any other questions after that. So a little intro to it. SMT, what does it stand for? Well, it's called a smart money technique. Put that in quotes because that's what ICT call it. It's just everybody knows what you're talking about when it's an SMT. We like to call it a Spitfire Traders suck my titties. Whether you like that or not, I think it's quite amusing. So yeah, all it is a simple divergence. Okay, so I only use ES and NQ for this. Other people look at YM, but personally, I get everything I need from ES. It's a very, very simple concept. We're looking for correlated assets to diverge. Okay, so if you are familiar with CVD divs, this will come pretty easily to you. SMT should not be traded alone. Okay, only ever in confluence with a more in-depth trading plan. All right, so here's the structure. So if one asset takes the high and one asset doesn't, you have an SMT. Okay, so you have a trade there. If you've obviously got some sort of entry model, some sort of idea. Okay, this is just the general structure. If neither take the liquidity, then you don't really have a trade there. Okay, if both take the liquidity, you still have a potential trade. Okay, so this is essentially like the go no go zone. As you know, we want to trade from liquidity generally, but the beautiful thing about SMTs is they allow us to get that entry when we haven't swept liquidity on one asset, but we maybe have on the other. Okay, so I'll just reiterate that in a minute. So once you go down the rabbit hole of SMT, you're gonna see these things everywhere. So it's important not to get lost in the noise of the lower time frames. Configuration, typically we look for a run on liquidity prior to an entry, like I just said. SMT allows us to get into an entry without a sweep. So as long as the correlated asset has taken the high or the low, then we're good. Okay. So another key thing about this is SMT, like any other technical tool, should utilize a clear and obvious approach. If you're struggling to spot SMT, it's probably too low time frame or messy. Okay, so you must ensure you only pull them from pivots. All right. So time frame slash entry. There's a few ways SMTs can be utilized, but I think it's easier to segment them by time-based principles. For instance, 15-minute to 4-hour SMT. So you're using 15 minutes all the way up to 4-hour pivots. Okay, so if you see an SMT at that time frame, this is what we'll typically be looking for. So best application in my opinion is around this time frame where you get a 15-minute and above. It should be visible on the 15-minute, and it works the best when it's accompanied with time-based liquidity and a particular model. So a really good example of this is the hourly sweep prior to a 4-hour model, which is the modules that went over last session. So obviously we get the Spitfire entry model when we sweep a 1-hour high or low, and then we can play that 4-hour model on the back of it. Obviously, if there's an SMT at that 1-hour high or low, then we're still able to grab that entry. The other thing is 5-minute and below. So what you'll typically hear me refer to as local SMT. This is often well accompanied with a low time frame entry, and it offers confluence and sometimes better risk to reward, which I'll cover in a sec. You will often find local SMTs correlate with higher time frames, which in my opinion gives them more merit. But a lot of the time as well, if you're looking on like the 1 minute or around those low time frames, 5 and below, you're gonna see a lot of SMTs, and ideally you want them to stick out on a higher time frame because sometimes they can get congested within singular candles and pretty much invisible on a higher time frame. But yeah, anyway, we've got 4-hour and above as well. So macro SMTs, these are good for bias, but they don't really give you any sort of entry. Okay, so good for bias, but requires more time to develop and additional work required on the lower time frames. Okay, so in regards to stop placement, just really, really simple rule. Your stop goes to the most immediate high or low. Okay, so in this example, you've got the SMT. If you, let's say you took this entry on the short, you would have your stop at the more immediate high. Okay, so it would be on the lower high of this SMT. If this high had been taken, obviously you use that high. Okay, so you can see how that, obviously this is not the best example, but you can see how your risk to reward changes here. Okay, so that's what we're doing. Now, here's some more examples. You can see here's a nice one. Some local SMTs there, nice inversion. Get a really nice solid entry. That was a trade I did actually take, and I did get in a little bit earlier on that as well. But this was just a really nice example of the 2 to 2.5 standard deviation, and you get a nice 3-minute inversion. I think that is 5-minute inversion with an SMT. And then obviously you're also pointing down towards midnight, which is nice. Yeah, here's another little example. You got some local SMTs here, so you can see ES does take the low. And by the way, if you like this configuration that I've got here for my chart, and you want to add ES into like a bottom pane by just double tapping, and you'll be able to bring it up or put it away. Let me know, because it's dead easy. You just go up to the plus icon at the top of Trading View and you can add it in a new price pane. But I like to use it as almost like an indicator at the bottom. So here you can see local SMT, ES takes the low, NQ doesn't, and it begins to expand upwards. So really nice, and you can see that around these 1 hour candles that I've got over here on the right. You can see how 7 a.m. doesn't take 6 a.m., but on ES it does. Okay, so you've got time-based liquidity there, and you've got S&T at that time-based liquidity. So this is an example where you would have had that nice 1 hour confirmation as well as a local S&T. So here's another example. You can see up here, just really, really simple. You failed to take the high, and you've taken the high. And that was the 3-minute example that I gave over here. So that's the same one. You can see how that works out quite nicely. When you're failing to take highs, but you start to see that bearish price action, you can start thinking about those shorts. Okay. Here's the macro. So this is quite an obvious one. So the macro right now, ES had taken the all-time high, NQ didn't. And now we've started to see that vicious sell-off. Okay, so really, really nice confluence on that. Okay, so this is the final bit I want to go through, but it's really, really important because, in my opinion, ES leads the way. Okay, so like I said, I use ES like an indicator. It's great for spot and draws on liquidity, and it will more often than not take NQ with it. Okay, so if I see bullish ES, I'm more inclined to think NQ will rise. Okay. And if I see NQ rising, but I'm suspicious of that, so if I see NQ rising, but I'm seeing ES look heavy or kind of bearish, I'm a little bit more suspicious of that rise. Excuse my grammar there, I need to fix that. So essentially what I'm doing here is I'm placing more weight on ES. So if ES is moving up and NQ is lagging behind, I'm more inclined to think NQ is going to follow it. But if NQ was moving up and ES was lagging behind, I'm less inclined to think that ES is going to follow. Does that make sense? So I can almost be a bit more suspicious of a rise on NQ. And that's essentially how I look at it. So this is a really good example, really obvious example. This here, obviously, this example is 5 minutes before New York opens, so it's a no trade situation, but it offers a really obvious example of leading here. ES falls hard and runs into 6 a.m. lows, whilst NQ is still 130 ticks away. So you can see in this example, at the exact same time, ES has already ran and taken those lows, all right? But NQ is 130 ticks away. So what you're able to do is you read into this, right, okay, NQ is probably going to crash further. Okay, so this could prevent you from taking longs, or this could potentially keep you in shorts. You know what I mean? So this is just context. Obviously, in this moment, right now, there is technically an SMT because ES took the low and NQ didn't, but this is not an SMT you would act upon, which I'll talk about next. And yeah, here's a nice little example as well. This is why we utilize SMT. It's critical to get a confirmation signal. When we utilize SMT, it's critical to get that confirmation signal. Pardon me. So here's another example. In this example, we can see ES taking the high 80 minutes before NQ, all the while technically we have it SMT, but in this instance, ES was leading NQ higher. So you can see here on this example, ES already takes that high. NQ doesn't do it for another 80 minutes. Okay, so in this instance, that whole period, we technically have SMT, okay, during that 80 minutes, but we can't really act upon it because, or we shouldn't act upon it because ES is showing us that it wants to move higher. It's just consistently holding bullish gaps and breaking bearish gaps, okay? So there's a good example of ES leading NQ there. So this is where we come to the importance of PA, or price action. As mentioned above, the critical point of SMT is getting your confirmation signal / price action markers aligning with the idea. So for example, if we have a bearish SMT, we need to see bullish gaps begin to fail. Understanding the price action markers that inform us of price's intentions is essential to being able to utilize SMT effectively and spot ES when ES may be leading. And yeah, that was the other example. Utilize SMTs in confluence with standard devs and time-based liquidity. So this is a really, really good example of this, because you run that previous 1 hour high, you form the SMT, you're in a standard deviation. This is just a beautifully technical example of SMT. And that's it. I'll move on to questions and I'll stop the recording.